So very quickly on learning objective 3, now that you know how to calculate the cost of an asset, now you know about useful life, depreciation, salvage value. It's important to know what happens when companies actually dispose of those assets. So there's usually 3 options for them. They either sell it to a private party, um, they exchange it for a new piece of equipment that's the same, right? Or they basically scrap it. It's retired. It's not useful. They can't sell it to anyone. They can't exchange it. It's not, doesn't have a value anymore. Okay. So what we call either a sale or an exchange or a retirement, we call that a disposal of a plant asset. So if you're going to sell it or junk it, you need to take it off the books. And in some cases, you'll sell it for more than what it's worth on your books. Sometimes you'll sell it for less than what it's worth on your books. So that's just basically the concepts we're going to be looking at today. Okay. Whenever you do sell it or you do retire it, it has to be journaled on that date. And what we usually do is we have to reverse out the asset from our books. Remember, this is a plant asset, so it's going to be, say, an equipment account and accumulated depreciation. So you have to close both accounts for that asset. When you eliminate the asset, you're going to take away the accumulated depreciation for that asset. You're also going to credit the asset account to take it off the record. Everything, when it comes to a sale of an asset, you look at 2 numbers. Okay, the proceeds is how much you sold it for. Okay. And you compare that with the book value. Okay. So let's say I had a truck. Remember that wonderful truck that we were looking at for Bill's Pizza? Had a salvage value of $1,000 at the end. That would be its book value at the end of 5 years. Let's say I went ahead and I sold it, to Pat, because, Pat's a hell of a guy, always wanted a pizza truck, and I sold it for $1,300. So in this case, the proceeds would be the $1,300 that I'm going to collect from selling the truck, compared to the book value of the truck of $1,000. So basically, because my proceeds are higher, right, the proceeds are greater than the book value, I'm going to have to recognize a gain, a $300 gain on that sale of the asset. Okay. But what if it was just the opposite? What if Pat knew that truck wasn't worth very much, although he was quite fond of it, and he offered me $600 for the truck, and I said, okay, fine. I want to get rid of the truck anyway. Let's do it. $600. Well, in this case, the $600 that he gives me is the proceeds, right? The book value is $1,000. So I just sold $1,000 truck on my books for $600 in cash. So in other words, the proceeds are less than the book value, and so I'm going to record a loss when I sell that asset. Okay. Gains and losses on disposals of assets are on the income statement. Remember that portion of the income statement, the multi-step income statement that said other revenue or gains, other expenses and losses. That's where this amount would be showing for that year. Excuse me. Okay. And again, once we actually do sell our planned asset, we also have to make sure we are appropriately journaling what we're doing. So in this case, this is an illustration where this company sells furniture on July the 1st. Now, assuming they have a regular calendar year as their accounting year, July the 1st means that they've owned it for 6 months. They've used it for 6 months in 2017 before they sold it. Okay. And so that's important to notice. They sell their furniture for $16,000. Okay. I don't know what the F is doing here. Um, on January, on July the 1st, 2017, Wright sells office furniture for $16,000. Okay. This should be if. If on January the 1st, 2017, it had a cumulative depreciation of $41,000, they need to depreciate the first 6 months of 2017, not iCash. Okay. There's a lot of mistakes here. The office furniture originally cost $60,000. And this is a horrible slide. Screw it. It's not going to make any sense. Let's go right to this is a little easier to follow them. So their office furniture was they bought the office furniture for $60,000. The accumulated depreciation on that office furniture, including the first 6 months of the year, was $49,000. So the book value of the office furniture was $11,000 on the books. Okay. They sold that equipment for $16,000, much higher than the book value. So the difference is $5,000 has to be listed as a gain. Okay. And so what they would show on the books is receiving cash of $16,000. They would reverse out the accumulated depreciation. They would take the piece of equipment out of the equipment account. So the $60,000 credit to equipment takes the equipment off. The $49,000 debit to accumulated depreciation for the equipment takes the equipment off. So this basically takes the equipment out of their books. What's left is a $5,000 gain that they're going to have to recognize. Okay, because the difference between this is the $11,000. Is the $11,000. So in this case, this gain is going to be reported on the income statement. And that's basically what you need to know. So it's going to go on the income statement. Don't have to really get into too much information. Again, this is incorrect here on this slide as well. If they sold it for $9,000 instead of $16,000, again, you have a book value of $11,000 for the furniture, but they've only sold it for $9,000. This $2,000 loss would be in the debit side. So that's a mistake as well. Okay. But anyway, what you really need to know is that gains and losses on the sale of any plant asset happen when you compare the book value and the proceeds. If the proceeds are more, it's a gain. If the proceeds are less, it's a loss. And it gets reported on the income statement. That's something you have to know. The accounting, a little less so. Those slides were absolutely horrible. Okay, so again, all we need to know is recognizing that. So let's see if we can practice it quickly here after those miserable slides. The book is much better. The slides are the problem, not the book. This example in the book is perfectly laid out. It's just on the slides, it's screwed up. So they have an old truck, Overland Trucking. The cost of the truck is $30,000. The depreciation on the truck is $16,000. So again, the cost minus the accumulated depreciation, that's going to be your book value. All right. So the book value of the truck is $14,000. The difference between the cost and the accumulated depreciation is going to be the book value. Right. So in scenario one, they sold it for $17,000. Well, if they sold it for $17,000, they sold a $14,000 truck. That was their book value of the truck for $17,000. So what are they going to do? Well, they have to recognize a $3,000 gain, right, in the first scenario. They're going to have a gain of $3,000 because the proceeds are greater than the book value. What if the truck is worthless and the company just simply retires it? Well, they still have to take the truck off the record, off their books. They have a $14,000 truck. That's their book value of the truck, the difference between the cost and accumulated depreciation. And they simply retire it, the entire thing becomes a loss. So in scenario 2, the entire $14,000 will be reported as a loss that year, okay? And that's what you gotta know. All right, learning objective 4 is all about intangible assets. And believe it or not, these are just so critically important today. Most of the biggest companies that we have today are running on intangible assets, whether it's Apple or Microsoft or Amazon or Google. Most of their business model is based on intangible assets. So it's important to understand what they are. We're not going to be doing any accounting on these, but you need to know exactly what they are and how to identify them. Okay. So intangible assets are rights and privileges and other advantages that can be proven as ownership. Because it's an ownership, it's an asset. Okay. What are the common types of intangible assets? Well, like I mentioned to you, patents is really critical. So a patent basically is a government recognition of ownership of an invention. That invention can be something like a vaccine, like a COVID vaccine, or medicine of some sort. But when you look at Apple, the patents are on the iPhone, the MacBook, the iPad, all the inventions that Apple has are basically on the books as patents. Okay, they're recognized, government recognized that they own this. Okay, when you have a company like Microsoft, or in the case of Google with their web or with their web services, YouTube, other types of things. What we're really talking about here is ownership of a copyright. Copyrights are ownership of things that have created either by writing, so like the code that creates software is owned, by that. Copyrights are really big in music. So, all the artists that have hit songs have copyrights on those songs because that's the ownership they have. That's their property. No one can just decide to play their song without their permission. So that's how they make money, because they sell that. The permission comes in the form of a sale. Same with Microsoft, with software. Any software company, you buy a license to use the software. So that purchase of a license is the way in which they are monetizing the ownership, the copyright. You have to pay them to use it. If you don't pay them to use it and you use it, you copy it without paying, that's what pirating is, right? That's those types of things. Another company that has lots of copyright issues like Disney, all the characters that Disney owns are copyrighted characters. So whether you go way back to Mickey Mouse or Winnie the Pooh, their original big characters, or currently they own all the Marvel characters, they own all the Star Wars characters. So any of those types of characters are owned by Disney. How do we know? Well, because they have the copyright. They have the copyright to those characters, and so you can't use it without permission. So again, this ownership allows those companies to sell those particular products or ideas solely. No one else can do it. Okay. The same is true for franchises or licenses that are granted. That's very, very important to understand. For example, a lot of folks are big sports fans, whether it's NFL, NBA, NHL, Major League Baseball. Um, Major League Baseball owns, right, all of the rights to Major League Baseball teams. The Yankees are a franchise. The Mets are a franchise. The Red Sox are a franchise. All those teams are franchises. In order for a franchise to be granted, right, just what we saw when Cohen bought the Mets over the last year, he had to be approved by Major League Baseball. Well, why? Well, because it's a franchise. Major League Baseball owns the team. They own everything. It's just that Mr. Cohen owns a franchise in Major League Baseball. So, so there are franchises have a lot of rules that have to be followed for owners. Franchises don't have to be as large as the professional sports teams. It can be relatively small, like your local McDonald's, your local Subway, even the hotels, the local Marriott, the local Hilton. Those are all franchises. They're owned by, say, McDonald's Corporation owns McDonald's, but they enter into a contract where a person can buy the rights to use all the McDonald's stuff. That's a franchise. That's an agreement. It's a contract. Our friends on Route 9, when they started the Golden Corral, that's a franchise as well. Unfortunately, the first owner didn't go by the contract, right? He thought that he could do what he wanted because he was the quote unquote owner. Well, he was totally wrong. Golden Corral, the corporation, is the owner. He's a franchisee. He has to abide by the contract. If not, they can void it, which is exactly what they did. Okay. Then they found another owner to buy the franchise, and then COVID hit. That was just simply bad luck for that owner there. So franchises are extremely important to sort of understand and all of that. Trademarks, trade names, really important stuff as well. McDonald's owns the arches. Those golden arches are a trademark of McDonald's. Disney's, the mouse ears, the castle, whatever you see on a Disney product is a trademark. It's a registered trademark. They actually own that. There are trade names as well, like Kleenex. When you want a tissue, oh, can I have a Kleenex? Well, not all tissues are Kleenex, but Kleenex is a trade name. Even for, when you look at country music stars, or actually any stars, Keith Urban is a very large star in country music, but not only is that his real name, but that's also his trade name. Lady Gaga, that's her trade name. You cannot use Lady Gaga because it's already owned by Lady Gaga. She wasn't born Lady Gaga, right? It became a trade name. So all of these types of things are extremely important to understand that this is a business ownership type of thing. These are intangible assets that are owned. So if you try to, if you decide you want to be a Lady Gaga, I would expect that you would get sued for using the name, because the name is a trade name. So that's a very important type of thing to know. The last intangible asset that's talked about here is goodwill. And all I can tell you about goodwill is when one business buys another business, usually you're buying the assets of the company, and you can see on the balance sheet, they all have book values, they all have a value. What happens when you overpay for those? Let's say instead of buying a business for $100,000, which is what the assets say it's worth, you pay $200,000. You pay twice as much for the business. how do you account for all that extra money that you're paying for this business? Well, that's basically goodwill. Why did you pay double the price of the assets? Well, because the business has an incredible reputation. It comes with talented employees already in place when you bought it. It's in a perfect location. There's lots of things that go into goodwill. Here's an example of goodwill as related to Disney. Like I said, Disney owns a lot now. They were struggling about 10 years back because they were losing one of their more important crowds, preteens and teenagers. So roughly from like 10, 11 years old up through, and that's because they didn't have any really good characters for them. They went to Nickelodeon, they went to Cartoon Network, they have better characters for that age group. They couldn't come up with an answer, so they bought Marvel. They bought all the Marvel characters. So, Marvel characters have, again, these are copywritten characters. They bought them for a much higher price. They overpaid for Marvel. Well, where do they come up with the extra money? How do they account for that? They account for it as goodwill. A year or two after they bought Marvel, they bought Star Wars. They bought all of the Lucasfilms. So Disney owns all the Star Wars characters. And again, they overpaid for Star Wars. And that overpayment was made as goodwill. Okay. So important stuff to know in terms of what they are. That's the purpose of Objective 4. Are you able to identify all of these types of things? One thing that's important to know too is that some things have what we call an indefinite life. Remember, we talked about useful life for property, plant, and equipment. For intangibles, we look at what type of life it could have. Some items have what we call an indefinite life. Those mostly rely on things like copyrights, for example. For a copyright, that right extends through the entire lifetime of the owner. So, for example, if you were Lady Gaga, you have all these songs that are copywritten. The copyright is good throughout her entire life, plus 70 years after she's dead. That's an indefinite life. That music can be, sold even after they're dead. Prince is making a lot of money, even though he's been dead for, I think, about 10 years. Michael Jackson's making money, although he's been dead. These, and a lot of famous people, a lot of singers and so forth, even though they've passed, they're still making money, right? The estates are making money, but they're making money because the copyright. What happens when the copyright expires 70 years after they're dead, right? And that's when it's called public domain. That means anyone in the public can use it without needing a reference, per se, needing permission to use it. And so that's why you hear, every time you hear like classical music, Shakespeare, the copyrights are way down on those. And so it's part of the public domain. Anybody can do it. But you can't do that if the copyright is still intact. Okay. One other note on things like, so there's also a limited life. Patents are good for 20 years. Okay. Some patents can be renewed, right? But for example, I guess Apple can renew the patent on its original iPhone, but why would it want to? Because it has a new one, right? So patents for certain inventions would have a limited life because you wouldn't want to carry around the old iPod. Why would you bother? So no one wants to know, because it's part of the iPhone now. It's part of the whole package. So why would Apple want to renew a patent on its old standalone iPod. It wouldn't. It wouldn't. So it just becomes part of the new patent for its new inventions. So the original one expires. So it has a limited life. Has a limited life. That's even true for new inventions. Even if you had this stellar idea and it became an incredible invention, how good is it? How long is it going to be good for? How long can you cash in on it before the next idea comes and makes your idea look stupid? Right. So that's one of the questions you have to ask as a business person when you have a patent on my invention. What's its useful life? If it's limited, then that's fine. You're going to cash in on a certain period of time, and then when something new and better comes along, no one cares about your product, so your patent becomes worthless. It's part of the deal. But while it's there, while it's good, cash in. One thing that you need to know on patents in this country is drug companies, like I said, get a patent for their medications, for example, in their vaccines that we've been hearing about. Those patents are good for 20 years, but that creates for drug companies a monopoly in the drug. So if a drug company had a pill that cured cancer, for example, all you do is take a pill in the morning, cancer is gone by the afternoon. Well, they're the only company with that patent. They're the only company who can sell that particular medicine. There might be other drug companies making their own drugs that do the same thing. But the patent means that that company is the only company that can make that drug right now. So that creates a monopoly, particularly when you need certain drugs to keep you alive. And that's why drug prices are so high. Is because when you have a monopoly in a drug that's needed, you can charge any price, because what's a life worth? Right? So it's worth a ton of money. So you charge a ton of money. That's unfortunately how some of the drug companies look at these types of things. Patents on medicine cannot be renewed. So after the 20-year period is done, the patent expires. And when a patent expires, anybody can make the drug, which is why generic drugs are so cheap. A generic drug is a drug that the patent expired, so anybody can make it. And so they do, and it creates low prices for customers. But again, to be a generic drug, that patent has to have expired. So like aspirin, Longon, Tylenol, Advil, Motrin, all those patents are expired, which is why everybody can make it. And that's why you can buy a bottle of aspirin if you wanted to for like $1, right? Because the patent's expired, it's done. Anybody can make it, so there's lots of supply. So that's important to know. That's important because it's going to affect the business. It's going to affect the business. It's going to affect your decisions on the business. Trademarks can have an indefinite life. You can renew trademarks as often as you like. Dunkin' Donuts, McDonald's, they all renew their trademarks. Okay, as long as that business is there, you can continually renew all of that. So that's the deal with that. Your book has some things here about it. Oh, by the way, patents. Any type of intangible asset, they go through a process called amortization, which is sort of like depreciation for your property, plant, and equipment. Some intangible assets will go through that similar process, but the process is called amortization. Okay. But not everyone can use amortization, particularly if amortization can only be used if the intangible asset has a very limited life. And you're going to cash in on it now, because 5 years from now, you're probably not going to, something new is going to come along, take its place. However, if the invention or patent or copy, other things have an indefinite life, there's no amortization. You can't expense it. Okay. So your book goes through some examples of that. I just went over all of that. So learning objective 4, basically, can you identify that? That's basically what learning objective 4 is in a nutshell. Learning objective 5 is where some analysis is going to happen, and there's a couple of easy ones that we can do. First, you know how property, plant, and equipment and intangible assets are shown on your balance sheet, right? These are specific classifications of assets. Notice that for property, plant, and equipment, this is usually how it goes. Land is going to be listed first. Buildings is usually listed second, because a building is a plant. And machinery is equipment. So just like it says property, plant, and equipment, that's usually how it's listed on the balance sheet. Okay. Intangible assets do not have a particular order to them. Here, this is for Coca-Cola. Coca-Cola actually owns that big, C. They own a bunch of other types of things. So they have trademarks on all of that. They give franchises to bottlers. And so those franchises are intangible assets to them as well. So, and Coke has been known to buy other products at a high price, so they have goodwill. So that's how it's listed. 2 pieces of analysis here to wrap up this chapter. The purpose of having assets is to use them to make money. So return on assets talks about, are you making any money? And so return on assets is about net income, which is your profit, divided by your average total assets. So the average total assets, your total assets at the beginning of the year, plus your total assets at the end of the year, divided by 2 to get an average. Right? So what does it mean is that your assets should be generating profit for the company. That's why you bought them in the first place. So that's a return on asset. So here we have some data on JetBlue for 2014. They had a $515 million profit on about $7.5 billion of average total assets. So 6.8% return on assets means that for every dollar in total assets, it's generating almost a 7-cent profit, which is fantastic. That's wonderful. So this would tell me that JetBlue is really using their assets quite wisely here. Okay, much better than in 2013, where their return on assets was very low, 2%. Now it's at 6.8%, much better. Okay, compare that with Southwest Airlines in 2014. Hey, Southwest is nothing to be shy about either. 5.7 is also an excellent return on assets. Again, this is the amount of profit you're making on every dollar of total assets. This is awesome as well. Okay. Compared to the industry, in this case, the industry is the airline industry. Look at all the airlines. Their return on assets is averaged 4%. As you see, Southwest is flying at a higher altitude here. Comparatively, and JetBlue is well above 30,000 feet. Okay, they're really flying high. They're doing quite well. The reason you have assets is to sell. So asset turnover looks at, are you using your assets to generate sales? Okay, because that's why you have all those buildings, equipment, etc. You want to use them to sell stuff. Asset turnover is calculated by looking at the net sales, comparing that with the same number we looked at before, the average total assets. Okay. So here we're looking at JetBlue for 2014. They had net sales of $5.8 billion over average total assets of about $7.5 billion. So they're looking at 0.77 times in an asset turnover. Another way you can read this, just for it to make a little bit more sense to you in explaining it, means for every dollar in total assets, they're generating about 77 cents in sales. So that's a way in which they're using their assets, how to measure it. Clearly, that was better than the previous year for JetBlue because it went from 7.75 to 0.77. So the higher that is, the better, because it means more net sales for your total assets, right? Southwest here is really doing a great job, okay? For every dollar in average total assets, they're generating 0.94 times that as a turnover rate. So they're generating about 94 cents in sales on every dollar of total assets, which is outstanding. It's an outstanding rate. They're doing really, really good on using their assets to generate sales. Compared with the industry as a whole, in that same year, 0.8 times roughly the industry for every dollar in total assets. They're generating about 80 cents on each dollar in terms of a sale. So clearly, JetBlue is very similar to its competitors in the industry, but Southwest, got to tip your hat to them. They're doing an awesome job. Okay. We don't have to worry about profit margin. We've already looked at profit margin in an earlier chapter, but we do have to look at these in more detail here. The asset turnover, very important to know. So here we have Paramore Company, $180,000 of profit, net sales of 420. Total assets of 460 at the beginning of January, 540 at the end. So here you're going to average these two numbers to get your average total assets. And they want to know what's the asset turnover. Well, again, net sales divided by average total assets. So your net sales are 420,000. Your average assets would be around 500,000. So your asset turnover rate, 0.84. And that's the review. That's the review. How'd that go? Any questions?